I thought, like putting out the letter, I thought I would actually do the same presentation I did in January, but I thought, well, that's pretty lazy. But a lot's happened that I've been covering in the letter, and so I thought it might be worth it to go back to this thing we call the investment clock. And so this investment clock has got 12 hours, as it should, but it's really done by this Lion Selection Group about characteristics of where you are in the cycle. We'll stick to the gold sector because the clock can be different. You know, you can add things. You know, like I added this thing about leverage to gold, financing risk. You know, you could put your colonoscopy in there, whatever you want, whatever triggers you. So here, in terms of the initial shock, especially for base metals and industrial metals, the shock is lower global GDP growth. So right now in 2024, where we are right now, there were higher rates, and that posed a challenge for industrial commodities like copper. What's driving the average up is basically still China and India, and most of the G7 nations are basically below the global average. And importantly, 2004, the forecast is below what the average was for 2023. And then in terms of 2023, these are the commodities and the ETFs that I tend to follow. You know, the demand for commodities in China got satiated a bit. We had a lot of weakness in the real estate market. We had a stronger US dollar because interest rates were going up until they peaked. Some of these critical minerals were getting really hit badly, like, but off of highs, off of some very high highs, like lithium carbonate equivalent, down 80%, nickel down 44%, palladium down 38%. But interestingly enough, M&A activity kept the base metal equities ETF just about flat. But the important thing is that people thinking about risky sectors, you've got the broad equity markets, which are very liquid, outperforming and giving you 24 and 43% returns. And so that's really where most people's focus was. And this week, I think both are hitting new highs right now. The only commodity that really did exceptionally well was uranium, and the uranium equities still underperformed. They did not provide leverage to the underlying uranium. Bitcoin did well, but let's focus in on gold. The gold price did well. It was up 13%, but as you could see, the leverage wasn't there as proxied by the GDXJ that was up 6%. So the next topic we'll talk about is this leverage to gold price. And so the blue line is the GDX, the major ETF for senior golds, and then the actual gold price. And this is taken from the end of 2018, so it'll be indexed from there, from 19, 20, 21, 22, and 23. So you see the index performance of gold versus the GDX, and you can see where points where the leverage was extreme, and that's what you want to see. You want to see this leverage. But lately, we have not been seeing the same kind of leverage. And part of the reason is the reasons what drove gold up, and what was driving gold up was central banks. So central banks were doing a lot of buying of gold, and they do not care about equities. And so that buying did not spill over into wanting leverage with equities. Whereas if you had institutional equity and other investors in it for leverage, they'd be switching to the ETFs and the senior producers and then moving their way down to the juniors. The other reason that we didn't see this leverage kick off was higher costs. And as I'll show you, and some of this was related to lower grades being actually produced. So this gives you the idea about the compressed margins. And so the red line, and this is from Ron Stewart of AUCU Consulting, who's now with Leeds Gable. So you can see the red line is the gold price, the quarterly gold price over the last 5 years. The black line is the all-in sustaining cost. And so during this period, Gold had risen from 1250 about 40 to 45% to over 2,000. But at the same time, you had all-in sustaining costs rising. So all-in sustaining cost margin peaked around 48%. When I worked for Newmont in the 2000s, we usually did an EBITDA margin of 50% that we would eat away with capital. But that's where they're sitting here. But now they're down in the mid-30s with respect to leverage. With respect to margin. And so even though the gold price, what was that? Yeah, sorry. You see, even though the gold price was up, it wasn't offering you much gain. And so that's another reason that the index didn't provide you any leverage, or the gold industry did not provide you any leverage to the gold price. And so the other problem of where we are in terms of the clock is the elevated financing risk that most of the companies outside would be able to tell you more about. So even though the total amount of financings for all the known commodities that the S&P Global Market Intelligence covers was slightly down, only 4%. What people talk about sounds like it would be much worse. So it was $12 billion, and now it's $11.6 billion. This is all over every equity, ASX, TSX, venture, what have you. The important thing is that most of the money is going into the gold sector, and the gold sector was down 17%. So that was about $1 billion less money going into the gold sector. So from 5.3 billion to 4.4, with almost the same amount of financing. So the same amount of financings looking for less money. The big winners, and what kept it just down 4%, was the amount being raised in critical minerals like lithium, rare earths, and other commodities. So using the TSX Venture as a proxy for juniors, let's say, but this would include oil and gas as well, but let's just use this as a proxy because it's not a bad one. You can see that the first line here, the gray line here, is 2022 money raised Canadian dollars monthly. The black line is what was raised in 2023. This lighter line here is the IPOs, the initial public offerings every month on that exchange. And then the black line was 2023. This one was 2022. So the results say that the number of IPOs, new companies coming out, was about 60% less overall than the previous year. The total amount of money raised, about 27% less. And so only the months of February and August in 2023 got close to what was to 2022. Again, stronger demand, but fewer funds available. So going back, governments raising taxes. So in West Africa, you've probably heard about a lot of the coups and re-coups that we saw in the Sahel region of Western Africa, all the way from Sudan to Guinea. Burkina Faso, which is one of the big producers of gold, about 7% of global output. This was their old royalty scheme, that everything over 1,300 was 5%. And now the new scheme is anything over 1,500, 6%, but now we're over 2,000, so it's 7% NSR. So that kind of thing is going to happen because most governments will only see the gold price going up. They won't see your costs going up as well. So now you have higher costs, and now you're getting hit by a higher royalty. Company liquidations. And so this one happened. So Madsen was put into production back in August 2021 as pure gold. Their head grades didn't come as expected in the feasibility study. It halted operations, suspended them, and applied for protection. I only bring this one up because that reverse vesting order that they put together actually happened in 2023. And so right now, still unsecured creditors are still owed about $150 million. But you could see that share price about 286, down to about 15 cents. So that's your example of liquidations. Asset write-downs. So Newmont would be the big one that just announced their Q4 earnings. And you can see that they had a net loss of about $3.1 billion when the gold price was over $2,000 an ounce. So they redid their geological model for Peñasquito. And so if you complain about a junior company rejigging their model for their asset, you can look and see that majors do this as well. And when I worked for big companies, it was more so that we had a portfolio of screw-ups that would look okay. That's how you got to imagine a bigger company. So inflationary pressures in Canada, Musselwhite and Eleanor, and you could see those inflationary pressures, as you look at Argonaut, and Magino still, and then Cote as well, with the capital cost overruns they've had. Yanacocha Reclamation, another $1.2 billion. And then their integration with Newcrest, another $427 million of costs just for that. And so they drained $300 million of free cash flow the last quarter. And so if you look at their last few quarters, they were actually generating, $350 to $400 million in cash flow. So this was quite the swing of almost $700 million of free cash flow going the other way in one quarter. So if you look at what they were promising during the Newcrest merger, was to reduce their long-term debt by at least $1 billion and to generate annual cost savings of $500 million after acquiring Newcrest. Some of that is going to come from these divestitures. And so some of the M&A that we've been waiting in the gold sector was waiting for this shopping list of assets to see what was going to come out of their portfolio of producing assets that people might want. So nobody's going to buy a developing asset or anything else, some of these mid-tier producers, until they find out what's available from the Newmont-Newcrest merger. So these assets, coffee was one people have looked at before, Javier's Western Australia, but you can see a lot of the Canadian ones here, the Porcupine, Musselwhite, Eleanor, Telfer's Western Australia, Cripple Creek's in Colorado, and Akyem in West Africa. So, they're definite sellers because they've already told the market that they want to basically lower their long-term debt. So they can't get out of not doing it. Another write-down was this thing in Utah. This was a Cisco development with their Tintic gold and silver deposit. So this one, they have a Caribou project in BC, which was Barkerville, and they also have a San Antonio project in Mexico. But the emphasis has been on this what appears to be a high sulfidation system that's bursting through this quartz site along these faults. It's a low tonnage, 620,000 tons, but very high grade deposit. But the impairments related to their projected OPEX and CAPEX, what they thought was going to happen versus what they think is going to happen now. Different processing methods, different mining methods, different head grades. So everything that you want to know, they're still not sure they know it. And that impairment is anywhere from $80 up to $120 million. So if we look at metal prices stabilizing, if we look at the gold market, so this is the dot plot that everybody looks at, because really the gold price, and I'll show you in the next graphic as well, is related to the trend for real rates. And so everybody saw that the real rate was peaking in Q4 last year. But then how quick and how fast would the fall be is what pushed gold price and interest in gold equities to the latter part of last year. There was this idea that there would be up to 6 rate cuts in 2024, and that's what people were anticipating. And then when you see what's happening now most big banks aren't forecasting the first rate cut until June. So that reduction in rate cuts and deferral, as you can see from the next graphic, is what's holding the gold price. So you can see here, gold price down here at about 1,800 in October. This was still a lot of central bank buying that pushed that up, even though real rates were rising. But as real rates peaked at about 2.4%, that plunge there, that's what started making gold go up. And that's when you saw other investors coming in, inflows into ETFs. Everybody was looking pretty good. And then this happened. Now those cuts that we were talking about, there's not going to be 6 cuts. Maybe those cuts don't happen in March. Maybe they happen in June. So all that is making real rates come back up again. And that is basically making gold falter. It's not plunged, which is a positive, but it's sort of like straddled in this range, but thankfully still over 2,000. So M&A, and this is always a good sign. And so recently we had a multiple bid for a gold project called Twin Hills, operated by Osino Resources in Namibia. So at the end of the year, last year, Dundee Precious Metals, which also has operations in Namibia, offered about $287 million, half cash, half shares, for Osino Resources, a decent premium to their 30-day volume-weighted average price. So it's, you know, a lowish grade open pit, 1 gram, you know, similar to the open pits in Northern Ontario in terms of grade, 2 million ounces, more obviously in the envelope, 3.2 million ounces, valued at about $66 an ounce. If you take what the value is in US dollars. But last week, importantly, a Chinese group, Yintai, offered another 28%. So now the bid's $368 million. And this, importantly, is all cash. So that's a good sign once we're seeing all cash bids for gold assets. There's a bit of politics in this because for the Chinese to acquire assets, there's some places they can't go anymore. And so Africa is still a place they can go to. Whether this transaction actually closes with the way the Canadian government is reacting to Chinese ownership, that'll be probably the biggest risk right now. But in the end, they still have the Dundee offer in the background. Another much smaller transaction happened in Nevada for an oxide gold resource at Pony Creek that was contact gold, 433 ounces at half a gram. That was acquired for about $18 an ounce. And this was more of a what we'd call a bolt-on. So Orla bought Gold Standard Ventures and got this property package. And then Pony Creek is this one. This is Nevada Gold Mines, the joint venture between Barrick and Newmont that basically envelop it to the north and the south. So if we wanted to look at the relative valuations, this line here, again, this is from my colleague, my friend, Ron Stewart of Leeds Gable. You can see, obviously, to be a producer is a good thing. You definitely get a premium over not developing. So this line here is for people that are not producing. This is their total metal inventory in terms of resource. The same thing for the producer. So the producer average of this spectrum is about $120 an ounce. Spectrum for those that are not producing, the average is, you know, quite a bit less, probably a fourth of that, and that's the average right there. And you can see that Twin Hills got taken out above the average, which is good, because the last thing we want to see is more of this, where people are getting taken out for a liquidity event and people are just okay with that, and you just get shares of the other company. This was at a premium, and this was all cash, and so that's a good sign. Okay, so checking the clock for the gold sector, we're hitting a lot of buttons there for people to basically take a lot more interest in the sector. And in conclusion, I'll leave you with some quotes from the other Oracle of Omaha: spend less than you earn. And so I translated that in not having any children or living in Nebraska. Invest shrewdly. I translated that into avoid the junior mining sector. Avoid toxic people and activity. So management is key, and don't bungee jump. So try to keep learning all your life. So a lot of site visits, which we do at Exploration Insights, and fewer conferences. But I do like this one. Do a lot of deferred gratification. And so that goes contrary. That does mean a lot of investing in the junior mining sector and having children. And as somebody on Twitter said, seriously think about what kind of world we are living behind for Keith Richards. Okay, that's it for me. Thank you very much.